Receiving a pension in retirement is a beautiful thing. You've got guaranteed income for the rest of your life. However, it does come with a few tax implications that you need to be aware of. In today's video, I'm going to be going over 3 different tax complications that your Washington State pension creates for you. Now, before we dive into that, just want to let everybody know that I just launched our free school community. So it's for Washington State employees only. That's where I'm going to be posting a bunch of exclusive content. I've got free courses coming out, and we're going to have live monthly calls. So if you need to ask questions or anything like that, you can go in there and ask the group as a whole, or you can go jump on a live Zoom call with me and ask me in person. It's free to join. The link is going to be in the description below. So now, first and foremost, the thing you need to know about your Washington State pension plan is that it is a pre-tax benefit, which means taxes haven't been taken out yet, which means every time you get paid, you're going to have to owe taxes on it. Now, how much taxes you owe is going to be completely dependent on what income bracket you fall into. Now, over time, tax brackets will change. The amount of income ranges will also change. If you move into a different state that has income taxes or tax pension plans, then you may have to pay more taxes in those states as well. So the amount of taxes you have to owe is always going to be a revolving number. Now, I say this because a lot of people are in the assumption that they don't have to pay taxes on their pension in Washington State. And oftentimes this is because they've heard that Washington doesn't tax income. Now, Washington State doesn't tax income, but the federal government does. So even though you're not going to pay taxes to Washington State because they don't tax any income here, you still have to owe the government taxes on your pension benefits. So yes, your income from your pension is going to be taxable. Now, what kind of complications can this create? So I've discussed this in the past, but basically when you have guaranteed income coming in on a pre-tax basis, it creates a floor or a baseline of what your income is going to be, which is, again, it's a beautiful thing to have, but it also means that whatever bracket that income puts you in, for the most part, you're going to be stuck in it. We can't do any kind of fancy tax strategies to get you into a lower bracket. Remember, in your retirement, we can't contribute any money into entire retirement accounts, so we can't, defer income and job brackets that way. The other thing you can really rely on are standard deductions, which are, again, written in pencil. They can change at any time. And the only other strategy that some people could use is charitable giving. But at the end of the day, you're still giving away money, and you're never going to come out ahead in the tax game just by giving money away to an organization. The math just doesn't work out that way. As you get into retirement, your deductions get less. If you don't have dependents anymore, you have less things to write off. If your home is paid off or nearly paid off, the amount of interest you're able to write off is a lot less now. So there's not much you can do to wiggle your way out into a lower tax bracket. So for Washington State people, when you have pensions coming in, let's say at $2,000 per month, and then you have Social Security coming in, call it $2,000 a month, that's $4,000 per month on a pre-tax basis, $40,000 per year. Now, wherever that lands you in the tax code, that's the bracket you're going to be in. So the reason why I say this creates a trap for you is, should that bracket change, you could owe more taxes. So while you may be making $48,000 this year, or potentially down the road, if they decide to change tax rates, even though your income hasn't changed, you could owe more in taxes, which means you get less money to take home from. If they say, hey, we're not going to change brackets, but we're going to cut the standard deduction in half, like they're planning to in 2026, now I can only write off half of it. So for example, if I was making $40,000 and the standard deduction was $12,000, I would take $48,000, take away the 12, it would bring me $36,000. I'd only be taxed on $36,000 of income, even though I made $48,000. That's why your standard deduction works. And if they say, hey, we're going to move that to $6,000, now my $48,000 minus 6 is now $42,000. Now I owe taxes on $42,000. So even though they didn't raise rates or change anything, you still owe more money in taxes. So there's a couple of those sneaky little ways that you can actually end up paying more in taxes without them even changing tax rates. All right, so that's kind of the situation that you're in with the state pension plan. Again, it's not a bad thing. It's just important to know how it's going to affect you down the road. Now, we discussed why it's called a tax trap, because you're kind of stuck in this bracket. But remember that anytime you have any other income that's pre-tax, could potentially bump you into another bracket. So for example, if you're working and earning income, that counts as taxable income. If we took money from any type of pre-tax account, be it a 403b, an IRA, some money from deferred comp or your Plan 3 account, that's all pre-tax money. That's going to come in and that's going to cause your income to go up, and you're going to owe more taxes on that money. So if our Social Security and our state pension plan, we said we had a baseline of $48,000, and let's say we're in the, for example, 12% bracket, and that shifted to 22% when we hit, let's say, 60,000. Again, this is total hypothetical. I'm not going off the actual numbers here, just giving you concepts to understand it all. Let's say the next bracket jumped up at 60,000. If I pulled $20,000 off of my deferred comp to go buy a car or something like that, the first $12,000 I pulled, right, from 48 to 60 is going to be taxed at a 12% bracket. But the $8,000 over that, any money past 60 would be now taxed at the 22% rate. So just because you pull extra income and you jump into a new tax bracket, doesn't mean all of your income is not taxed at a higher rate, just the amount that is over it. But that does mean that of that distribution, you are paying 22% on $8,000 of it. So while the pension is nice, because it's eating up a lot of your taxable brackets, most of your distributions that you're going to be taking in retirement are going to be taxed at higher rates. So when people say, hey, I'm making less in retirement, therefore I'm going to be taxed less, that's not always true, because your state pension plan and Social Security create a baseline to make up a majority of that income. And if you're making less, most people are dropping so much less that they're changing multiple brackets. They might go from 24 to 22%. So you may go down a little bit, but it's not going to help you a great deal. And if taxes change, that 22% bracket goes to 25, you actually are, and it may end up owing more money in retirement, even though you're making less income. So now that explanation on the way, how do we manage this? So if we can't really reduce our income to change brackets, the best thing you can really do is to plan distributions accordingly or do some proper tax planning. So if we know we're in a certain situation where we are in, let's say, a 0% long-term gains tax environment, and we had money in stock, we could therefore sell the stock, realize the gain, and it would cost us nothing. It's a 0% rate. So leveraging different tax brackets is a smart thing to do, so you can essentially bring in income or sweet profits without increasing your taxes. Now, because distributions from most people's retirement accounts are pre-tax, this is where Roth conversions is a big part of it. By converting, especially earlier in your career, even if you can do it before you retire, is really good as long as the numbers work out. And what that does for you is allows you to move money from that pre-tax account into Roth. Yes, you're going to pay taxes upfront on that money. You're front loading it now. But any growth you get from that day forward is now going to be yours tax free. So the longer you wait to do a Roth conversion and the bigger account gets, the bigger the portion the IRS is going to take from you. So by doing it early in your career, you're doing it while your balance is smaller than it's going to be in the future. And you're also starting the tax-free growth process earlier, so you can realize more compounding years for you. So by doing this type of planning, if you were in that situation where your pension and Social Security added up and you're right at the top of a tax bracket and you want to jump to the next bracket, let's say you're in a 22% tax bracket and the next one was 30, for example. You're like, hey, I don't want to go into that bracket. You could then pull money from any kind of after-tax source, be it your savings account or a Roth account or some type of investment account. So by having money in different buckets, it allows you to manage taxes a little bit better in retirement. One of the biggest mistakes I see people do is they go into retirement, they have all their money in Plan 3, they leave it there or they move it to IRA and they do no tax planning. They just let it sit and grow, pull from it if they need to, and it just gets bigger and bigger and bigger. And at some point when they need money off it, they have no other way to turn but to pay taxes on it. Now, the past few years, taxes haven't been too bad, but should that change, they're going to be in a really tight spot because they're now going to be forced to pull money out at a higher taxable amount. And force meaning that if they need the money and that's the only option, they're going to have to take it out from there. And if they don't need the money, RMD is going to kick in and some point down the road and make them pull it out anyways. So proper tax planning is a really good way to help reduce your overall tax bill. And it's a really important part of financial planning process I think everyone needs to do. Now, the second tax issue that you're going to face when collecting a pension plan has to do with your Social Security. So Social Security actually has something called provisional income, and that determines how much of our Social Security is actually going to be subject to taxes. So it's not the tax rate you pay. You still pay the normal marginal rates that are posted on our website. This just says how much of it do we owe on it. And there's three. You either owe nothing on it, you can owe tax on half of it, or up to 85% of it. And it all depends on where your income hits on their brackets. So because we have Washington State pension, that counts as income. 100% of that money is going to be counted towards our provisional income. Now, provisional income is all of your earned income, so money that you've earned, plus any interest that you earned. So if you got money from bonds or CDs, that counts as income. Any type of pension would count as income, retirement distributions is income, and half of your Social Security. So you add all those numbers up, that counts as your provisional income. So, for example, if we had $2,000 a month coming from Social Security, only half of that would count as provisional income. So it'd be about $1,000 per month or $12,000 per year in the provisional income calculation. Now, if we had $2,000 a month from your pension plan, that's $24,000. We add it to your Social Security, you'd be at $36,000. And you got to see where that hits you inside the provisional income bracket for Social Security. So I have in front of me here, if you're filing single, income between $25,000 and $34,000 means that up to 50% of your Social Security benefits come subject to taxes. If we go over that, anything over 34,000 as a single filer is 85%. So what I just told you there is if we had income at 36,000, we're now over that 34 threshold, 85% of my Social Security is not going to be subject to taxes. Now, in the event where we were under that 34,000 threshold, we'd only be owing taxes on half of our benefits. So to put it into context, give an early example, if we had $2,000 per month from Social Security, it's $24,000. If we only own tax on half of it, or $12,000, and would say we're in the 22% bracket, we would have about $2,600 in taxes on $24,000 of benefits. But since we're over that threshold of $34,000 as a single filer, and we're now paying on 85% of it, you take 24,000 multiplied by 85%. So that means $20,000 is subject to taxes. So we owe taxes on $20,000 instead of 12. Now our taxes that we paid is $4,400, $4,488 to be exact. So you're seeing your taxes essentially almost doubled just because you went over that threshold. It doesn't matter how much you go over by. In this case, we only went over by $2,000, but that was enough to bump us into that different bracket and cause more Social Security to be subject to taxes. Now, once you're past this area, like I said, there's not much you can do about it. It just kind of is what it is. But your Washington State pension did eat up most of that income. Now, the bigger problem lies if you're not over that threshold. So sometimes we meet people that their pension's not as much. So let's go back, and let's say your pension was only $1,500 per month. So if we said, hey, we got $18,000 per year from our state pension plan, and we got, again, $2,000 a month from our Social Security, but provisional income purposes, we only look at half of that. So we got $12,000 to it. Now we're at $30,000. So now we're under that threshold. Only 50% of it subject to taxes. That's great. But if we decide to take any money from retirement account, that's going to bump us potentially into that 85% area. So for example, let's say we're at that 30,000 threshold, only half of our Social Security is actually subject to taxes. If we took $10,000 out to do whatever with, renovate the house, buy a car, whatever it is, you took it out. Now our provisional income is $40,000 for the year. And that's going to push us obviously into that 85% bracket. So a couple things here. This is what's known as the tax torpedo. So when I take $10,000 out, and let's say I was in the 22% tax bracket, yes, I'd owe 22% on that, or $2,200. So if I took $10,000 out, $2,000 be withheld, I'd be net with $1,700. So I paid $2,200 on that distribution. But because that pushed me from half my Social Security subject to taxes up to 85% of my Social Security being subject to taxes, you got to kind of figure out what did that actually cost us, by doing that. Like I said previously, when we're only half of it subject to taxes, we only owed about $2,600 from Social Security. Now by us going over that threshold, over the 34,000 and 85% of the subject to taxes, it jumps us up to $4,400 in taxes owed. So not only did that $10,000 distribution cost us $2,200 in federal taxes, it also caused more Social Security subject taxes. So now we're paying an extra $2,000 on our Social Security benefits and taxes. So our $10,000 distribution actually cost us a little over $4,000 in taxes. So even though it says 22% tax bracket, you effectively actually paid about 42% in taxes for that one distribution because you're inside of this bubble created by Social Security and the way they tax benefits. So again, this bubble is something that you really can't do a whole lot of. It's just important to know about it and know how to manage it so you can either stay under it or stay within it so you don't cause yourself to pay extra in taxes from taking distributions without knowing it. This is why it's very important to have tax planning. And this is where a lot of DIY people that go from advisors go wrong. They blindly take money out. They think they know the tax system. Yep, I'm going to take money out and just pay 22% tax bracket. But they forget about little loopholes like this one and they end up paying more in taxes than they realize. Now, at the end of the day, if you need the money, you need the money. It's just important to understand the tax consequences to go with it. Because let's say they didn't need all 10,000 of it, they're doing it for fun. Maybe it would have made sense to split the distribution up between two different tax years to potentially avoid the situation. Now, if you completely blow past this, then the effective rate goes down once you're past the bubble. But it's this kind of area that can be really tricky to navigate from a tax planning standpoint. And again, your state pension plan is part of the problem. Without the pension plan, or if you had a tax-free pension, for example, none of that income would be counting towards your provisional income limits, and you'd have a lot smaller of a tax bill. Now, the third tax issue that you may face with your Washington State pension plan, it has to do with the survivor benefits. Most people, when they select their survivor benefits on their pension plan, go with either option 4, the 66% option, or option 2, the 100% option. In other words, they're electing to give their spouse that survives them either 100% of their benefit or 2/3 of it. Now, the reason why this creates a tax problem is for the widow or widower in this situation, when they start getting your pension plan, they're also going to change brackets. They're going to go from the best bracket, right, married, family, jointly, down to the single bracket. So now the income thresholds or limits are half of what they used to be. Side deductions also half what they used to be. So if the surviving spouse income doesn't drop by 50%, they're going to essentially move up in that bracket. So they're going to be either higher or deeper in the bracket, or they may change brackets completely. Now, this is what's known as the widow's tax trap. So because our state pension plan is all pre-tax and if our spouse gets 2/3 of it, it's going to help and support them, but it's also going to cause them to potentially pay more taxes down the road. Same goes with Social Security. When someone passes away, the higher benefit sticks. So unless you guys are making the exact same amount, the higher benefit is going to stick, and it's usually going to tip over that 50% line. So that spouse is going to end up with more than half of what you guys used to making when both Social Security checks were coming in. Therefore, when it comes down to tax time, the brackets are half as much, standard deductions half as much. That widow is going to end up paying more in tax. So this creates kind of a tax pinch for them. Now, this isn't something that can really be avoided. I mean, of course, if you took option one and left your spouse with no pension, maybe they wouldn't be in that situation, but almost never do I ever recommend a couple ever choosing option one, the 100% option, and leaving their surviving spouse with nothing. The amount of deduction you take from electing survivorship benefit is so small, and if the spouse outlives you just by maybe a couple of years, you're going to get more money out of the system than you otherwise would have. So if you're thinking of taking option one, the full benefit because you don't want to pay the state or take a deduction, I would highly advise you to reconsider that. So there's nothing you can really do to avoid the widow tax trap. It's just understanding to know that it's coming and to plan for it. So if taxes are going to go up, that also means that they're going to have less income coming in. If the income is still sufficient at that point to cover their needs, that's great. If not, we may have to start tapping into other assets to cover the shortfall that's now created, whether that's be loss of income or because taxes are higher. So again, this comes back to proper management, but from a tax and retirement planning standpoint, to take care of the surviving spouse down the road. So if your financial plan hasn't included what it looks like for the surviving spouse, then you need to go back and revisit it sooner rather than later to make sure that your surviving spouse is going to be well taken care of. And don't just assume that the money you leave her and the income that they're going to get is going to be enough, because it is a really big change in their life, and they may not have the same type of investment mindset that you've had. You may think that leaving them a giant stock account is going to be great and they'll have no problem with money, but if them looking at the account, not understanding what's going on, not showing what the fees are, being over-concentrated in stock and not wanting to touch it all, may just cause them so much stress. They may blow it, and if they don't know what they're doing, they may go and squander the money either on large lavish purchases, which I've seen happen, or they may make wrong investment decisions. So especially true if you're a DIYer. Just because you like investing your own money and like to manage it doesn't mean your spouse does. And if they were to outlive you, they might not know what to do with it. So it's important to have some type of plan in place, whether getting them up to speed or have an advisor picked out so that when the time comes, they can go to someone that you trust, that you picked out while you're still alive, to help your surviving spouse managing the money to make sure it lasts and goes to the people that you want it to go to. So the moral of the story of this video is that proper tax planning and proper retirement planning are very important. Washington State pension plan is a great thing to have. I wouldn't change it for anything, but you need to understand the tax consequences that can kind of come with that level of guaranteed income on a pre-tax basis and different strategies that are available to help manage it. Again, if you guys want more exclusive content and access to a couple of free courses coming out, join the free school community. Link is in the description below. Until next time, remember that your future depends on what you do today.